What's going on, everyone? Charlie here. I'm just going to give you a quick reminder that it's very simple. The confusion's coming from everyone trying to figure out why it's happening. The focus needs to be on how it's happening. That's the easy part. But I'm going to go and remind you that this is very simple as far as the how. It's just a lot of information that goes into it. So if you're overwhelmed, don't be. If you're experienced in the market with options, with trading in general, this may be especially difficult for you to embrace considering the contrarian mindset regarding the logic. That's where you must remember, despite any experience level, any complacency in trading strategies that worked in the past, that cannot be used in this situation because there has never been a time such as this in the financial markets. So don't let complacency get in the way of what I'm about to explain. Here's why it works. So this is a query that I've ran. I used Alphaquery.com. There's if you use the NASDAQ stock screener, it returns about 8,600 tickers. Now Alphaquery was unable to get all those tickers, so of those tickers it pulled about 6,200. So this isn't a sample of the whole market, but this does show the point that I'm trying to make. So we have 1940 tickers between 0 and 30% institutional ownership. We have 1341 tickers between 30 and 60% institutional ownership. We have 1896 tickers between 60 and 90% ownership. And then we have 1364 tickers with 90 and 120% institutional ownership. That is an absurd number. Now, the thing is that Alphaquery returned a lot of these with a zero value. So the fact is that this number here in this range are likely even higher than what we get here, because a lot of these zeros that were recorded was just from Alphaquery not being able to gather that data. So keep that in mind. So many of the ownership positives were positions were entered in as blank. So the number of ownership is greater than 60% that we see here, more than likely. This is why there's no liquidity in the market, and this is why all the shares have been bought up to be used as collateral. If all of the float is owned for a vast majority of all of the tickers, because there was an SLR leverage ratio that allowed this to happen, then there's not going to be many shares freely trading in the market. And the reason why they had to buy up all these companies is because of this. The giant share lending operation that started in April of last year that surged to historic levels, and this is why complacent trading doesn't work here. Unprecedented. New horizons here. This is nowhere even close. So you have to look at the policy, the macroeconomics, and what the hell's going on here. So the demand for repo has never even been close to these levels before. So if all of the companies' floats were bought last year during this time, where can we see the effects of this in the market? Well, since we know options don't trade after hours or pre-market, we can assume that most stocks won't trade much volume after hours, and during the intraday period, the majority of the orders will come in as multiples of 100. Now, I won't be able to show you the multiples of 100 on this video because it's not during market hours, but during the week next week, go look at your time and sales. Look at the orders coming in. You'll notice one thing. If it's not a highly interested retail stock, you're going to see multiples of 100 the majority of the time because they're controlling it through options exercising. And this is exactly what we see happening. So when we watch this here, you can clearly see after hours, they closed for the day at 0.00% all the way down. Nothing was traded after hours because, again, there's no shares freely trading because you just saw they're all bought up by institutions. So what does this do? This ties up their liquidity. If it's all being used in the collateral system in the repo, then the real issue isn't a liquidity crisis. It's a collateral crisis because the liquidity is being needed to churn collateral. So now that we know the liquidity planning occurs in the options chain, or the majority of it, when could we expect mistakes to happen, or overreactions based on underlying company information that's changing? If it's all set up in the options chain, then you're going to get overreactions and underreactions, and they're going to happen on earnings, which is exactly what happens. All these stocks gap on earnings, which is likely overreaction due to the options liquidity from the underlying changes in the company that may or may not have beaten expectations. That's literally all this is. And this will continue to happen until the repo demand changes, meaning easy exploitation. The strategy is simple, the why is complicated. The how is easy, and I'm going to show you the how next.